Hey everybody, thank you for joining us. We wanted to introduce you to Jacqueline Zerbe and Keith Baker of Verico Total Mortgage to discuss the new mortgage rules. I'm Christine Kopr, realtor with Sotheby's International Realty Canada. That's a mouthful. Anyhow, some really interesting information was released on Friday, June the 5th, some big changes for CMHC. And so I'm going to pass the mic over to Jackie and Keith, and they're going to give us a lowdown on what's coming in the mortgage market. Jackie?
Thanks so much for having us, Christine. I'm just going to share a screen here so that we can discuss the rules that were introduced. So as Christine mentioned, there were some new rules that CMHC introduced on Friday. So in Canada, there are actually 3 mortgage insurers that will insure your mortgage. CMHC is the Canadian Mortgage and Housing Corporation. That's the one that most consumers recognize. And that's a Crown corporation. Then there's 2 other insurers, Genworth and Canada Guarantee, and those are public organizations. Lenders will use all 3. And it's important to note that it's only CMHC that made this announcement last week. And usually anytime there's rules that are introduced, they're announced by the Ministry of Finance, not by the insurer. So that's something to keep in mind over here. So CMHC's announcements that they made last week were that they're going to change the gross debt servicing ratio and the total debt servicing ratio, also known as GDS and TDS. So they're lowering them from 39 and 44% down to 35 and 42%. And that effectively is going to reduce the mortgage amount that you can qualify for by up to 12%, which is significant. Another rule that they're changing is that they're requiring that borrowers' minimum credit score will be reduced from 680 down to 600. And then the last introduction is that they're not allowing you to have borrowed funds from non-traditional sources for your down payment. These rules that they introduced were communicated quite poorly. So there's a little bit of vagueness in exactly what they mean with respect to non-traditional sources. So this week, they're going to come out with a little bit more clarity, because people don't understand if that means that they can't borrow from a line of credit or that they can't borrow from other sources. So you are still able to borrow from a gift from your parents, for example, or from immediate family, but you're not allowed to borrow from an unsecured line of credit. Now, in terms of when these rules kick in, they'll happen effective July 1st. So that means if you have a purchase agreement and you have an accepted offer on a property already, these rules won't affect you. So you have to have received an accepted offer by July 1st and submitted it to a lender and an insurer in order to qualify under the old rules. With respect to why it's happening, oh, go ahead.
Oh, I was just going to say, now this isn't for everyone that's getting a mortgage, right?
Exactly.
Maybe I'm jumping ahead here just so that the audience knows it's like, everyone's going to be impacted by this.
Perfect. I was going to bring that up next. So this impacts you if your purchase price is less than 20% of the down payment. Okay. So this is considered if your mortgage is high ratio or insured. So if you have less than 20% of the purchase price, this is going to affect you. And predominantly people that are first-time home buyers or people that are moving up the property ladder, those are the kinds of people that have less than 20% down. Okay. And basically, people are wondering why this is happening. So CMHC's president and CEO has said that COVID-19 has exposed longstanding vulnerabilities in the financial markets, and they're trying to act to protect Canadian home buyers and reduce government and taxpayer risk.
Okay.
So awesome. That's the close notes.
Thank you so much. So, a few questions arise out of that. Now, you mentioned that there's 3 insurers in Canada that insure high ratio mortgages. And are the other insurers going to be following suit?
Well, at the present moment, Genworth today announced that they're not making any changes to their underwriting guidelines at all. So in other words, they're not going to be following suit with CMHC.
Okay.
We have not heard from Canada Guarantee, but given that they're both public corporations, the expectation is they will stay the same. They will compete with each other and leave CMHC to just do their own changes. It's also important to note that all prior to these mortgage changes for high ratio mortgages, the premiums for insuring your mortgages are all the same. Doesn't matter whether you're using Genworth or Canada Guarantee or CMHC. The premium that gets charged by the insurer is the same for everybody. So now the only difference is going to be with Genworth not changing their underwriting guidelines, and hopefully Canada Guarantee not changing their underwriting guidelines. The benefit's going to be that if people go and get an insured mortgage through one of those two companies, they're going to be able to qualify for a higher mortgage and hence a higher purchase price than if that file was to be sent to CMHC. And as mortgage brokers, we can request a lender to send a specific file to a specific insurer.
Oh, that's great. So the opportunity is still there, because if someone's working with a mortgage broker like yourselves versus maybe going to a bank where they have a rule that they can only work with CMHC, then you might be capped. If they're working with a mortgage broker, say a borrower is working with a mortgage broker, then coming to someone like you can go and approach the other lenders that are still able to use the other insurers and help these people get the prices or the mortgage amounts that they would have previously qualified for.
Exactly.
Is that correct? Okay, awesome. I think we're going to go into a little bit of a Q&A here now. I was just thinking that we might want to go into full screen mode, unless you want to keep the bullet points on the screen. Either way is okay. And then we can continue on, because there's a few other questions that come out of this. So now, coming back to the fact that this change is impacting insured mortgages, so people that are putting less than 20% down to enter the home market or to purchase another property. It sounds like there's going to be another insurer opportunity to be able to continue with status quo should no one else decide to change the rules as well, because this didn't come from the federal government. This was just a change made by CMHC themselves, right? This is not like a federal regulation. Cool. So one, there might be two more insurers that could still provide the type of mortgage financing amounts that are typical today. And then the second part is when we think about the percentage of mortgages that are unconventional or insured, when we think about, say, like your book of business or the business, like say mortgage business in general, how many people are using high ratio mortgages?
Mm-hmm. So there was a survey done that was published on Statistics Canada's website last year, at the end of last year. And just over half of Canadian homeowners that have a mortgage are conventional.
In actual fact, 53%.
56%.
Okay.
Yeah.
Okay.
56% of mortgages in Canada are conventional.
So
okay?
this impacts
so 46 would be high ratio or insured.
44.
Sorry,
Okay.
44, sorry. Now, of those people that are in arrears in their mortgages, so in other words, people that are more than 90 days late in making their mortgage payments, over half of those people have conventional mortgages. Sorry, 2/3. So 1/3 of those are insured mortgage holders. And the default rate or the arrears rate is 0.1%. So 0.1%. So it's so
all
so
mortgages.
Small. Of all mortgages held in Canada, the default rate is 0.1%. And of that 0.1%, only 1/3 are insured. So that means changing these rules, in my opinion, is going to have very little impact on that default rate, which is the biggest concern. One of the reasons that CMHC is bringing this in.
Right.
Right.
Yeah. Interesting. So, okay. So of all the mortgages over less than half are insured, and those are the ones that are going to be impacted by the tightening of these rules to up to 12%, you were saying, in terms of the purchase price or purchasing power of a borrower. And I think the numbers that you're seeing in terms of the arrears, when was that published approximately?
That was also end of October last year.
Yeah, from the same survey. And, 0.1% default or mortgages that are in arrears is historically an all-time low. So it's not as though this has been growing.
Right.
So it begs the question for the federal government, why did you want to institute these rather harsh rules?
Right. And even if you had 100% increase in default, that's going from 0.1 to 0.2%.
Exactly.
Anyhow, I'll digress from that one. Non-traditional sources of down payment, because of course there are people out there who either are having to save up all their cash or coming up with down payment money from various sources, whether it's family, whether it might be lines of credit or whatnot, and you touched on that. So it's not exactly clear yet what's going to be limited or not.
So the expectation is that your non-traditional sources of down payment could be tapping into your credit card.
Right.
So historically, the lender or the insurer would then ascribe a monthly cost to borrowing that money. And they would generally ascribe a 3% charge to you if you're using your credit card funds for that. So they're saying no more of, you may not use your access your credit card to borrow against your credit card for down payment purposes.
Okay.
What isn't clear is whether you can use your unsecured line of credit. So in other words, a line of credit where you've just gone to the bank and said, listen, can you give me $15,000 or $20,000 unsecured, just on the strength of my name?
Right.
And on the strength of my name translate to having a look at my credit bureau, and here's proof of my income. And once they see your credit bureau, they can see what other expenses or other debts you're carrying and what your monthly obligations are, your motor vehicle debt, etc., any student loans. And so you won't be able to use those funds for a down payment, which typically up until now, or up until the 1st of July, you could have used that line of credit.
Right.
It would have been called a flex mortgage, right?
Right.
It's known as the flex down payment or the borrowed funds down payment program. So in reality, that program exists, but not very many buyers use it. So I personally don't see that having a big impact on the buyers that have high ratio mortgages or insured mortgages.
Okay.
I think the biggest impact is going to be that debt servicing threshold that's going to be reduced, and then the credit score. So in my book of business, most of my first-time home buyers are people that are moving up the property ladder that still need an insured mortgage. They're at that top range of the limit of the GDS and the TDS, because they're trying to move from a 1-bedroom to a 2-bedroom or a townhouse. So they're trying to get as much bang for their buck as they can. Having said that, my borrowers typically have decent credit scores. They're hardworking, they've got good jobs, they've been diligently saving their money, they've got good credit, they're responsible with their money, and so they're qualifying under the guidelines as prescribed by the government. So they are going to be hit a little bit with that reduced, the reduced ratios.
That actually brings up a couple points, because we're focusing on this, and in terms of how does that, say, apply to the entire real estate market? Well, can you even get an insured mortgage for a piece of property that is $1 million or above? And so insured mortgages are only for $1 million or less properties, if I'm not mistaken.
Correct.
Right?
Right.
So we're not even,
so
purchase price, $1 million.
Must be less than $1 million, so it would be 999. Yeah.
There you go. So first of all, we're also specifically talking to the segment of the market that is looking at properties that are $999,999 or less. So anybody out in the world who's looking at properties above that price point is either going to have to go conventional, have 20% down, and none of this even applies to them, right?
Correct.
Okay. And then and if you were to just anecdotally comment on your own book of business, when you think about your book of business and the mortgages that come through day in and day out, what percentage of people do you think of your book of business might this affect? If you're comfortable sharing.
Yeah. For me, the majority of my mortgages, and I would say 90% of my mortgages are conventional mortgages. So people buying above $1 million.
Right.
However, a conventional mortgage could also apply for somebody buying for less than $1 million.
Yes.
Okay. And where these new rules with CMHC would affect them is you could now, in today's marketplace, you can get a better rate on a mortgage if that mortgage that you get is insurable by the lender, which means that you might be buying a property for $900,000 and putting down 20%, which is a conventional mortgage. But to get the best possible rate, your mortgage broker would try and get the lender to do an insurable deal, which would give you a substantial or quite a meaningful decrease in rates. But then, if you're going to have to apply the CMHC rules, your client would have to qualify at a lending bar higher than what they ordinarily would have to, because now they'd have to qualify the mortgage on a 25-year amortization, and at least one of the applicants would have to have a beacon score of 680, and this could be problematic from a qualification point of view.
Okay.
But bearing in mind, we still got two other insurers that up until now haven't said they're going to make any changes.
So for example, you have your buyer that's a conventional borrower. They have 20% down. They're amortizing their mortgage over 30 years because they've got at least 20% down, but they're interested in the lower interest rate, which would be available if they had an insurable mortgage. So now they're reducing their amortization from 30 down to 25, and automatically that's increasing their GDS and TDS ratios.
Right.
So now on the 30-year, they might have comfortably been at 39 and 44% GDS, TDS. And now that you push them down to 25 years, they might have been at 35 and 42 at 30 years, but now that you've pushed them down to 25 years, now they're exceeding those new ratios.
Right.
So
then is the conclusion that they would then just go and stick with their conventional side and just have to pay the higher interest rate because then they can get more mortgage money. Okay.
Exactly.
Okay, cool.
And you know what, Christina, it's not always just about the interest rate, because you'll find a person says, I'm quite happy to pay that marginally higher interest rate, but I'm then going to have a mortgage payment that's more palatable for me. So I don't have to, really fasten that belt to make my payments every month.
Cash flow wise.
I know then I can plan for holidays or, spend money somewhere else. And always, because you can always manipulate your amortization term after your mortgage is funded by a number of ways. By paying accelerated mortgage payments, instead of accelerated bi-weekly payments instead of monthly payments, or making a lump sum payment against your mortgage, dropping $2,000 against principal, or doing a combination of those three things. Right. So it's more a question of what works best for a specific client.
Okay, super. That's a really great reminder to people out there. It's interesting because as I talk to clients, actually I find, and this is, anecdotal, I find a lot of my clients are actually quite conservative, and they want to make sure that they want to be able to get into property or in property, but they also want to have a lifestyle. And so it's important to them to really, make good decisions. And I think that's where speaking to a mortgage broker is so helpful, because you can see all the various options. And one other thing I just quickly wanted to touch on, I believe in 2016, we had like the stress test that came out January 2018 was the one that I felt kind of coincided with a change in real estate prices, where everybody who was getting a mortgage, didn't matter if you put 5% down or 95% down, you were subject to the stress test, which was qualifying at a higher interest rate. That, coupled with some tax changes in the marketplace for higher end properties, I feel like had some downward pressure on our real estate market. However, if I'm not mistaken, and I'd love for you to verify this, I believe that there was earlier that insured mortgages, so unconventional mortgages, the type of borrowers that are now having these changes done to them, they were actually already subjected to a stress test even before the conventional market was. Is that correct?
That is correct, yeah.
Okay, great. So I wanted to verify that just for myself, and we're all guessing as to what's going to happen in the future here. It's just, I remember that change happening, and I just remember real estate prices going up between 2016 and 2018 when the new B20 rules came in and affected the entire mortgage market. So with that, I wanted to thank you, and thank you so much for your time. This is really great, and I hope we can do it again, because I think that there's lots of opportunities to talk about various issues or topics in the mortgage market. So thank you so much, Jackie. Thank you so much, Keith.
Thank you for having us.
Yeah, and I look forward to doing this again.
Definitely.
We look forward to this.
And if you're listening, please make sure you reach out to Jackie and Keith if you have questions about mortgages and how they can help you get the mortgages that you want for the home purchase or refinance or investment property that you're looking for. So with that, thanks so much. You're welcome.
Thanks so much.